What's going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be doing some stock analysis for Blackstone stock ticker BX. And if we take a look at the share price here, we're going to see that so far in the last year, the stock is pretty much flat. It's down 2%. In the last 5 years, this stock is up 187%. It reached its peak at the end of 2021 at about $144 a share. Now we're down to about $91 a share. This is a market cap of $110 billion. Dividend yield of 4.2%, but we're going to get more into that in a little bit. And a P ratio of 112, which is a lot higher than normal. So first thing we're going to look at is their revenue. Revenue and net income, very important things to see if they are consistently growing. And as we can see for this company, it says they, on average, they grow at about 6.5% per year. But really, I think that's just because of this huge growth spurt they had right here from 2020 to 2021. They did over a 3x in their revenue. Really, it looks like it's been flat. It looks like they've been doing under $6 billion for the last 10 years or so. So I am going to give that a no. And the same thing with net income. It's pretty much a similar chart. It says it grew 29% on average over the last 10 years, but really it's flat. Really, they're doing $1 or $2 billion a year. And in 2021, they had a huge spike of $12 billion. So that's not what I like to see. I like to see consistency in the numbers, and it doesn't really show that there. So the P ratio for this one, I know I just said 112. And as you can see, if we look at the chart here, it's trading way higher than normal. Now, keep in mind, companies can have temporary declines in their earnings and things can shoot right back up. So that's why. But I mean, normally this stock is trading at a P ratio of about between a 10 and a 15, let's say maybe a 12 or 13, right? That's normally where it's at. So right now, I believe it's about a 15 or 20 on a forward basis. Let's see if it'll tell us right here. I think it's like a 15 or 20 on a forward basis, which is a lot. That's not horrible. See, forward P of 20. So, but that's definitely more expensive than where it's traded at for the majority of its history. So that's going to get I put yes, it's healthy, but it's not cheap. I would not consider this a undervaluation of the stock price. I don't really see how this company is innovative. What this company does is they are a investment in fund management. They offer fund management services in real estate, private equity, credit, and insurance, and hedge fund solutions. They were founded in 1985. And so it actually says this is the company with the largest, they're the largest company in this space for alternative asset management, I guess. And so I would consider this a significant player. They do have significant market share, but I don't really see the innovation here. I don't really see them doing anything different or unique. Return on invested capital, no. If we want to get into that, we will see that their return on invested capital numbers are, let's see here. They do have some good years. There are several years where it's above 10%, above 15%. That's great. But there's been 3 years out of the last 4 years where it was below 7%. So not consistent, and below 7% is really not that good. Growing equity, no. This one is a bit too. It's not consistent, and it's a bit kind of all over the place. There is a couple of years of growth, right? 14 billion to 15, or 14 billion to 21 billion. That's great. But I mean, it is decreasing, 21 to 19. And then look at the last 12 months, 21 to 18. So for the last 2 years plus, it's been decreasing. So that's not good. Equity is over 15% of the market cap, just by a little bit. I think it's about 17%. So that's good. Share count decrease. This is not good. They've been growing, which again, this is not some like end all be all metric to measure a stock by, but it's just something that, contributes to the way the stock performs and contributes to what we can know about how the management is managing the company. So shares outstanding, last 10 years. Again, though, this is another thing where these giant spikes are going to skew the data a little bit. So it says it looks like they're averaging 2 to 3% growth per year in shares outstanding. So not the end of the world. Sometimes it's for a good reason, but it is putting downward pressure on the stock. That's the bottom line. Assets minus goodwill are not 2x the liabilities, although they are close. I was surprised. I believe it's 22 billion in liabilities, 42 in assets. So that is actually better than most companies. Profit margin over 10%. This was also very surprising and in a good way. The profit margin for this company is nothing like the return on capital numbers. It's actually 41%, 74%, 43%, 62%, 26%. So that's incredible that they are putting up those type of numbers. I mean, they must be charging lots of fees to their customers, and it's all profit. Cash from receivables are more than average annual income. I think about what, 3 or 4 billion. 3 billion. Well, 4 billion from last year, but in the last couple of months, it came down to 3 billion. So that's good. Healthy dividend. No. If we take a look at, it won't let me look at it won't let me open up their cash flow statement. But so free cash flow, let's see, free cash flow, we're seeing a little bit of growth, but not, still it needs to be consistent. The dividend yield is 4%, which looks great, but the payout ratio here is 471%. So that's not good, not healthy. It is over 20 years old, and their free cash flow is not growing, although it is growing in the last couple of years. So maybe, hopefully, this trend can continue, right? This is obviously the best year for last year was the best year for free cash flow for them in the last 25 plus years. So, or at least 20 years. So that's good. That's a great sign. But I wouldn't be surprised if this number came right back down to $2 billion. So just got to keep an eye out for that. All in all, I mean, it's an interesting company. I mean, I would say that it's since they have such large market share, if they really do have that much of a moat in that alternative asset space, then I don't really see this company going under or anything like that. But I'm not interested. I'm not interested because, I mean, I will say I'm impressed by their profit margins, but I'm not impressed with their return on invested capital. I'm not impressed with their balance sheet. I mean, and I'm not, the most important things are like net income and revenue, and I'm not seeing any consistency here. I'm not seeing any growth or consistency here. So all in all, I give this stock like maybe a 6 out of 10, maybe a 7 out of 10 on a good day, but there's just better stocks that I'd rather put my money in. So that is my opinion for Blackstone. Thank you for watching. Comment down below what your guys' thoughts are on this, and if you have any other stocks you want me to make a video on, let me know and I will do that. So thank you for watching, and I will see you guys in the next video.